As a real estate investor, there are really two skills that you need to master in order to achieve financial freedom with real estate. Skill number one is sorting, finding, underwriting, and ultimately buying the rental property or the deal. Everyone knows this rule and they put so much time into it, which is important. But most people don't know about rule number two, which is about understanding and maximizing your return on equity. This is all about how hard or not hard your equity in the property is working for you. Now look, cash flow will help you retire from your job, but understanding equity, this will make you rich. And not just rich or wealthy, but generational type wealth. Now in this video, we're gonna break down return on equity so you understand how you can use it to grow the wealth, grow your portfolio faster, and ultimately achieve your cash flow goals. Now, I wanna give you a disclaimer on this video. Personally, it took about 6 months for me to understand and truly internalize return on equity. You're getting the crash course in a 10-minute YouTube video. So like a lot of real estate investors out there, I bought my first rental property, and then the second year, I got a little bit more cash flow. The third year, I got more cash flow. The fourth year, I got more cash flow. I was like, this is awesome. I'm making more and more cash flow. And that's what the blue line on this graph represents. Your cash flow is going up every single year. But what you don't understand is that beneath the surface, your return on equity is actually going down every year. And that's the red line. So it actually starts out oftentimes in the high double digits, but the return on equity starts going down every single year. All right, you might be saying, Chris, why does this matter? Because the higher percent return you're earning on your money or on your equity, the faster your portfolio and the faster your future cash flow is growing. So I will break this down over the next couple of minutes. So this is a very simplistic example of a year one investment on a property. In the first year, you'll make about $1,200 in cash flow, then $5,000 in appreciation, about $1,100 in debt pay down, and $640 in tax benefits or depreciation. Now, this is the numerator on the equation here. And let's say I put $25,000 down on this property. Great, well, that's my year one return. And as you can see on the screen, I'm making about 32% return on my money in that first year. Now, if you don't understand what these 4 ways of making money are, go check out our previous video on BiggerPockets, and we break down all these numbers on here. But here is the $1 million concept. As that appreciation and debt pay down pays you, where does that money go? It doesn't go in your bank account. It actually goes into the equity of the property. So I make $5,000 and $1,200 that first year. The next year, I don't have $25,000 invested in the property. I have close to $31,000 invested in the property through my equity in there. So keep that fractional math in mind. The equity is that denominator or what we're dividing your investments by. Now, don't get overwhelmed by this table I'm about to show you on the screen, but it shows you this property and what happens in year one, year two, year three. Look at that first column in cash flow. The cash flow is going up every single year. But now you can see that appreciation debt pay down from year one gets added to the equity in year two. And then if you look at the far right here, what keeps happening? Your equity increases. And then that your return equity actually starts going down every single year. It goes from 32% to 27% to 24%. So I'm going to flip back to the graph I just showed you previously, because this graph is the visual representation of the table. Again, that blue line is a cash flow going up. That red line is return on equity going down. So the return on equity is going down. The growth rate of your property and your portfolio is slowing down as well. Well, what do? Well, this is that key concept here I alluded to earlier, and this took me many months to understand. I now call this the investment to equity growth circle, because we want to take that initial money you put, the investment you put in the property, and then as it grows in equity in the property, we want to take the equity out and go reinvest it. Because we now have money in our real estate piggy bank, which is the equity in the property. We need to extract it and then go reinvest it. And guess what? That's how you keep a high return equity. That's how you start building your portfolio faster and faster without just using your own capital or your own money. Now that you have the concept down, I'm going to walk you through a 4-property investment model over the next 30 years to help you understand the concept. So let me set this up. You're going to buy a $100,000 property. You're putting down a 25% down payment. We're assuming a 6% interest rate and about $1,000 a month in rent. Now, I'm just using nice rounded numbers for model simplicity. And this was the same numbers I just showed you in the previous screens. So here's what it looks like if you buy that property and absolutely do nothing over 30 years. So from today, the property's worth $100,000. In 30 years, it's worth about $400,000. Congratulations, that asset has quadrupled in value. However, that also means your return equity is going very, very slow. Now, I'm adding a red line on the graph here to actually show you the equity in the property. You can see every single year that red line gets a little bit closer to the blue line, which is the property value. So your equity is building, which just goes back to that table I showed you a few seconds ago. Let's stop here for a second and talk about that investment to equity growth loop I was talking about, because we need to take the equity out and reinvest it. As a very loose rule of thumb in real estate, it's not uncommon to have your equity doubled in about 5 years between debt pay down, some market appreciation, and some value add you do to your property. So in this case, we put $25,000 down, and in year 5, we have about $50,000 in equity. So we're gonna take that equity and go from one door and go buy another door. And so that red on the graph represents the second door on there. And you can see the jump in property value. Why did it jump? Because we took the equity out and used it as a down payment and took out a new loan on another property. Where it gets so exciting is look at that year 30 mark. So that first property is about $400,000 in year 30. That second property, or with two properties, it's about $750,000. So again, concept here, equity out, go reinvest it. Now let's do that again at the year 10 mark in this portfolio. Year 10, our overall equity has doubled from about $50,000 to $100,000 now. Now we're taking out some of the equity and we're gonna go buy another property, another door, so we have another rental in our portfolio. And now you can see that yellow line, it jumps up in year 10 in total property value. Again, because we took the equity out and used it as a down payment on a new rental property. Now here's where it gets really exciting. Look at that year 30 mark. We were about $400,000 for one property, about $750,000 for two properties. Now with three properties, we're at over $1 million in property value. So hopefully you're starting to see the exponential growth of maximizing your return on equity. Now let's go through one more example and show us at year 15, taking the equity out and then using it as a down payment to buy another door or another rental property. Look at the green line on here. Now at the year 30 mark, close to $2 million in property value. So understand, this is over a 4x difference from one property where we just buy and do nothing versus us actively optimizing our return on equity. Now, there's a really interesting trend going on the graph here. Look at property 1 to property 2, that blue line to red line, and the distance between them. Then look at the red line and yellow line, properties 2 and 3, then the yellow line and green line. What do you notice? That every single property, that spread, the difference is getting bigger and bigger. And that bigger spread is more wealth and more cash flow to you here. And understand that by reinvesting the equity, this is like the compound interest effect. And we don't have the luxury as real estate investors to auto reinvest our dividends or our rent checks like we do in the stock market. So we have to manually do it ourselves by buying new properties. But the more properties you buy, the more future wealth you're going to make. Now, let's step away from property values and actually look what it does for cash flow. Because I know so many people are like, hey, this is great, but I want cash flow. I need cash flow to be able to retire. I need cash flow to pay my bills. I need cash flow to travel. So let's actually look at what it does to your cash flow. Again, these are the same 4 properties we just ran the scenario, and look at the difference in cash flow. In year 30, we're about $10,000 a year in cash flow. And you jump to the 4 properties, now we're at $40,000 in cash flow. That's a 4x difference in cash flow. So you now increased your cash flow by 4x with no extra money in our pocket, just by optimizing the equity. So you're taking the equity and you're creating more cash flow. Let's go and look at one more scenario on here. What happens when all those properties are paid off? Well, once those properties are paid off, we even see a bigger difference in cash flow. So now you're at over $150,000 in future cash flow when those properties are paid off, compared to about $30,000 in cash flow from one property. That's over a 5x difference. A common question I get here right now is people say, Chris, this sounds great. I get the concept, but how do I know when do I stop reinvesting my equity and just the properties pay off to make more cash flow? That is a great question. And this is something that you need to reevaluate on a consistent basis as a real estate investor. But my simple rule of thumb is that if you were to stop acquiring properties today, do you have enough cash flow or enough cash flow once the properties are paid off? If you do, then hey, you may have the luxury to stop buying new properties. If you don't have that luxury or you need more cash flow, then guess what? You need to stay in growth mode. And what I do, and most real estate investors I know what they do, is they go out there and they reinvest their equity. Now, they're reinvesting their equity, they're still finding deals, they're still saving money, they're still doing all of their stuff. But if you need more cash flow, then you're in growth mode. You need more properties. Keep your portfolio growing. The next common question I get is people saying, wow, this is amazing. I see the future growth it has on my portfolio. But how do I know when to pull out the equity? And should I do a cash out refinance? Should I do a HELOC? Should I sell the property and use a 1031 exchange to buy a new property? And this is a powerful question and one you need to constantly ask yourself. That's beyond the scope of this video, but our next video will actually go into a detailed breakdown of when you do nothing, when you pull the money out through a cash out refinance, or when you sell and go reinvest, because that really depends on the timing or what's going on in the market. It depends on the current conditions of the rental property, how good or how bad it is currently performing as a rental property. And our next video will dive into all those details. Now, I would love it if you could hit the like button on this video, and also make sure you subscribe to the BiggerPockets YouTube channel so you get alerted to the next video. If you have any questions or comments, post them down in the comments below. I'll do my best to answer them. But remember, this is YouTube. The best place you want to actually get real advice for your rental portfolio is head over to BiggerPockets.com. Go to BiggerPockets, go to the forum section and post about your situation, post your portfolio, post about your property, because you know what this YouTube video can't do? It doesn't know your location, and real estate's all about location, location, location. You can go to BiggerPockets, connect with local investors, local realtors, local lenders, and get a ton of information from the BiggerPockets community. I'll see you next time.